This is not a confirmed pattern, but if below 2,800, the neckline of this pattern would suggest that the S&P 500 could drop down to 2,650 for some bearish action ahead. To talk more about this and to connect it to futures on stocks along with options on those futures, I'd like to bring in Jay Pestrocelli of Zega Financial. Thank you so much for joining us.
Thanks for having me.
And what do you think of that chart of the S&P 500? Do you think that we could see a drop like that?
Yeah, no, absolutely. And we're seeing a lot of fear building up in the market. We're not the only ones noticing the way that chart is turning out, right? And so we're starting to watch. You look at the NASDAQ, you look at the S&P, fear indexes are starting to pick up a little bit, and that's being reflected in the options market as well.
Well, let's take a look at a chart that we have for you,
Sure.
taking a look at both the E-minis for the S&P 500 and the NASDAQ, because over the last 21 days, since that pink line, you're noticing a little bit of divergence that you're going to play. Show us how you would trade through the options market.
That's exactly right. So over the last 20 days, the NASDAQ has dropped significantly more than the S&P 500. And so we look for that divergence to come back into reconvergence over time. And so we're able to take advantage of that to a little degree. You can see how that separation is occurring. We could grab that, sell some option premium, make a little money. Now, you always want to be careful when you're selling premium. And so we could pair these two lines together so that we could profit on the NASDAQ volatility and benefit from an increased S&P volatility.
So let's take a look at your exact trade, a pairs trade, so that really you are protected.
Right.
And if I understand you correctly, unless the S&P 500 drops more than 10% in the next 19 days or 20 days or 30 days or something along those lines, you will make money.
That's right. So this is a June expiration, normal monthly June expiration. Oh, here we go.
Yep.
And we're looking at selling a bull put spread on the NASDAQ to generate about 4%, but then protect it by buying an S&P spread on the minis that's also about 10% out of the way, costing us 2%. So net, we'll make 2% on it. The chance of the market dropping this much is pretty low. We're talking, for that, it's like 3 weeks. You're absolutely right.
And so risk-off event.
It would be one of those black swan type events. It would be, even December wouldn't have caused something like this. It would have been really tough to get this to work, for this to fail. Of course, no guarantees, but this has a 98% chance of working. And so even if you get the correction that we're talking about, we're actually capturing this fear that's building up right now by